All right, so we're diving deep today into this whole idea of reasonable being better than irrational. We're looking at Morgan Housel's The Psychology of Money, Chapter 11. And right off the bat, he hits us with this story. A doctor who treated syphilis with malaria.
Oh, wow. Is that like a historical thing? We don't do that anymore, right?
You'd think. But get this. The doctor, Julius Wagner Jarek, actually won a Nobel Prize for it. Back then, syphilis, it was a death sentence, no cure. But he started noticing that, well, some syphilis patients, they would also contract malaria with those super high fevers. And some of them actually recovered from syphilis.
So he was like, maybe if we fight fire with fire, one disease to beat the other.
Exactly. It's like he saw a pattern, something that other doctors just missed. Now, of course, it was a huge risk. And unfortunately, there was a lot of trial and error. Some didn't make it. But it really shows what Housel's getting at.
Yeah.
Sometimes what seems completely irrational, that's where the breakthrough is. And that's what really leads to this whole reasonableness thing.
Yeah, it makes you think about how we decide what's a good decision. Like, here's this brilliant doctor going against everything everyone else thinks. Where's the line between, like, genius and just being reckless?
Right. And that's where this reasonable, over-rational idea comes in. Like, think about fevers. What do we usually do when we get a fever? We try to bring it down right away.
Totally. I'm grabbing the meds the second I feel a fever coming on.
Yeah. It's uncomfortable. But, there's actually more and more evidence showing that fevers can be good for us. Our bodies are fighting back. But we get so focused on that short-term discomfort that we miss the big picture,
That's a really good point. It's kind of like that whole future regret thing that Housel brings up when he's talking about Harry Markowitz, the Nobel Prize winner. He pretty much invented how we think about putting together investment portfolios, but guess what? He didn't even invest according to his own model.
Wait, are you serious?
Yeah.
The guy who came up with a perfect portfolio, he didn't use it himself. What? Tell me more.
It's true. He went with a simple 50-50 split, stocks and bonds. And why? He said it was to, and I quote, minimize future regret. He knew that if he was always chasing those absolute top returns, he'd just be second-guessing himself constantly and probably totally stressed out.
So it was more about, like, peace of mind than those extra gains, huh? Like saying, I'd rather sleep well at night than freak out every time the market drops.
Exactly. He was thinking long-term. And it's like this other study Housel talks about. It showed that, mathematically, young savers could really benefit from using leverage. But imagine the stress. Watching their retirement savings potentially disappear, most people couldn't handle that emotionally.
It's almost like our brains can get the theory, but our hearts can't stomach it, Makes you wonder if some of the financial advice out there is just too rational, too perfect for how people actually are.
That's a big point Housel makes. He says we should actually love our investments, not in a weird way, but like really believe in what we're investing in for the long haul, feel good about it even when things get rocky.
So it's more about knowing what your money's doing,
right?
Picking things that line up with your values and stuff.
Yeah. And that commitment is huge because Housel says, and this is a crazy stat, the odds of making money in the U.S. stock market, it's 100% if you stay invested for 20 years.
Wow. That's powerful. Time in the market, not timing the market. That's what matters.
Exactly. And that's where reasonableness really comes in. It's tough to write out the ups and downs, but if you stick with the plan, it usually works out in the end.
It makes you think twice about all those, stock tips you hear, all that pressure to get in on the next big thing. A little reasonableness could probably do us all some good. It's really interesting how we keep coming back to this, right? Sometimes the reasonable choice, it's not even about finding like the absolute best answer. It's what you can actually live with, for the long haul.
Absolutely. Remember that study with those young savers and leverage? Even if you could make like tons of money that way, think about the stress. Could you actually handle, maybe losing all your savings? Sometimes a good investment, it's about more than just the numbers.
It's like choosing a car. You can get that fancy sports car, all the bells and whistles, super exciting. But then there's that reliable sedan. Gets you where you need to go, no worries.
That's a perfect way to put it. And that's why what Housel says about loving your investments, it really hits home. When you actually get what you're investing in, you believe in it, you're less likely to just, freak out and sell everything when the market dips.
It's not just like stocks or bonds. It's like you're buying into a company's whole idea, or a product you really use, a future you want to see happen.
Exactly. And that feeling, that connection, it can be so powerful. It helps you stay committed even when things get tough. Like, remember that statistic, capturing U.S. market growth 100% over 20 years. It really proves that patience, it pays off.
Big time. Investing, It's not about getting rich quick, right? It's about putting your money to work consistently and then just letting it do its thing over time.
Yeah.
But staying the course, I mean, that's hard, especially with all the ups and downs.
Oh, absolutely. It's totally normal to feel anxious when, like, you see your portfolio drop, but that's when reasonableness comes in. You feel the feelings, you acknowledge them, but you don't let them, totally control your decisions.
So it's more about managing those emotions, not pretending they're not there.
Exactly. You got to realize, market dips, they're gonna happen. It's inevitable. Instead of panicking and selling off everything, take a step back. Ask yourself, okay, have things really changed, like about the actual companies I'm invested in? If not, well, maybe just stick with it.
That reminds me of what Housel says about forecasts.
Yeah.
Like, they're basically useless, right? Trying to predict the economy, the market. Good luck.
Yeah, I mean, we can analyze all the data we want, look for trends, but ultimately, the future's uncertain. There are just too many things that could happen.
It's like trying to predict the weather months in advance. You can make some guesses, sure, but then boom, sudden storm or heat wave out of nowhere.
That's the difference, right? Reasonable versus trying to be perfectly rational.
Mm-hmm.
It's accepting that some things you just can't control, especially the market.
So what do you do then? If we can't predict the future, how are we supposed to make, smart investment decisions?
You focus on what you can control, how much you save, how you spread your money around, your overall strategy.
So have a plan, but be ready to, change it up if you need to.
Right. It's like having a roadmap for a road trip. You have your destination in mind, but then, you might have to take a detour. Or maybe you see something amazing you weren't expecting, so you change your route.
It's like having a direction, but being open to, whatever comes up along the way. I like that. It takes the pressure off. You don't have to be right all the time.
And then you can enjoy the ride, which is important, but people forget about that part of investing.
Okay, so we've talked about peace of mind, managing emotions, accepting that we can't see the future. But what about the actual investments? How does reasonableness work when you're choosing where to put your money?
Yeah.
That's got to be tricky, right? It's funny, Ray, we've been talking about all these big ideas, thinking long-term, managing those emotions. But when it comes down to it, it's like, where's the money actually going? Any tips for our listeners, people who are trying to figure that part out?
Yeah, that's where it gets real, right? Housel, he talks about this thing called home bias. It's kind of fascinating how a lot of us invest. It's this tendency we have to favor companies that we're already familiar with.
Yeah, we touched on that a little before, but it seems so backwards, right? Like rational investing. It's all about diversifying, spreading your money around.
Right. Logically, you'd want to invest in all sorts of industries, different companies, even if you don't know much about them. Less risk that way. But then there's the psychology of it, right? We like what we know. It's comfortable.
Like if you love a certain brand, you're more likely to invest in them, right? Because you get it, even if it's just as a customer.
Exactly. And there's a logic to that, too. You might have insights that, just looking at numbers wouldn't give you. But gotta be careful. Too much home bias, you could miss out on some big opportunities. Or what if that one area you know so well, it tanks?
So how do you find that balance? Like for our listeners, how do they know if they're leaning too much on what they know versus diversifying enough?
First thing, just admit that you have biases. We all do. Then ask yourself, am I really okay with this much of my money in just this one area? Maybe start with a solid base of diversified investments. Then use a little bit for companies you have that connection with, almost like fun money, but, still thinking long term.
That makes a lot of sense. You get that emotional connection, but you're not putting all your eggs in one basket. That's what Housel was saying, right? Loving your investments. You find that spot where logic and feeling kind of come together.
Exactly. It's not about forgetting all about being rational. It's more like realizing that our emotions, they're part of this. And instead of pretending they're not there, we can use them to make better choices. Choices that we can stick with.
We're like our own financial therapists. And speaking of, we can't wrap this up without talking about Jack Bogle again. Mr. Index Fund, always preaching reason in investing. But even he didn't always walk the walk, did he?
It's true. Bogle was all about those simple, low-cost index funds, right? But he admitted that when it came to his family's money, he did things a little differently. Someone asked him about it, and he just said, well, sometimes you do things for family reasons.
That really stuck with me. Here's this guy. His whole career was built on rational, evidence-based investing. And yet, he knew that sometimes it's personal. Emotions, gut feelings, they all play a part.
It's kind of humbling, Even the smartest people in finance, they're still human. They get it.
And it brings us right back to Housel's main point. Reasonable Maybe it's not always the perfect answer on a spreadsheet, but it considers the whole picture, right? Emotions, biases, what we want in the long run.
It's about finding a way to build wealth that works for you in every way, something that lets you sleep at night, knowing you made choices that feel right, not just, look good on paper.
I love that. It's not about perfection. It's about doing things on purpose, making choices that will work for you way down the line. Well, this has been a great deep dive into reasonable rational. We hope everyone listening got something out of it, maybe even feel a little more free to think about money in a new way. And until next time, happy investing.